Good morning, everyone. This is Joseph Scarice, Nationwide Direct Private Lender, also the co-founder of the Creative Birth Strategies podcast, every Sunday morning, 9 a.m. But we have a special now, every second Saturday event where we bring in a guest and a live audience and do a Q&A and mastermind here at the rooftop deck at 2nd and Chestnut at Gold Ollier's office and TCS Real Estate Group here in Philadelphia. And today I have a good friend of mine, Evan Shweky. I haven't seen him a bit. I'm just excited to have him in the same room with me. He's managing partner of Delarosa Lending Group. Very diverse background. Attorney, was supposedly a movie star at one time. Right. Got some movie star credits. Investor, multifamily, true private money lending. And I'm happy to have him here today. Just want to give an update real quick before we can dive into this. Every Sunday morning we have a live subject every Sunday morning, 9 a.m. Eastern Standard Time, between Clubhouse and Spotify and Facebook, LinkedIn, and YouTube. But this is just a special. We always try to bring in a special guest to hopefully make some impact for our live audiences here this morning. And I put a group of questions together as well. So Evan, thanks for coming out today.
Glad to be here.
It's been a minute, right?
It's first of all, it's a beautiful day.
Yeah.
Beautiful Saturday morning. You have a very nice audience here today, and I'm always love to talk about real estate and growth and building wealth and health.
Well, we could touch on all that because we're all about that. You know, the subject today was diving into the market trends in real estate investment, but I think it's going to go a couple different directions with Evan and I, and I think the audience is going to hold off the questions until we get through some of these questions, and then we'll just open it up to the audience as well. So, Evan, can you briefly share your background, how your investing approach has evolved through different market cycles, and now going to this new year, knowing that there was this fraud case here in Philadelphia, and you're like, you could throw rocks to from where you reside. You know, how are you thinking now, knowing that this is present? How are you, how does this all kind of tie into what you're doing today?
So listen, you know, on a weekly basis, you can read in BizNow or anything else, any place else, whether it's real estate, anything financially related, there's always a fraud going on now. And with social media, you see these people, you think they're believable, they're trustworthy, and they tell you about these returns they're going to give you. And the fact of the matter is, nobody knows what tomorrow is going to bring. But they know what they're going to do with your money today, okay? And if they're not doing what they say they're going to do, it can be a problem. I grapple with this a lot because I think integrity is really important in business, and you know, we are in the lending business, and there are a lot of loans that come my way where I don't feel the borrower is actually going to get the return that they expect. Well, I'll review their numbers, and for me it's important to say, listen, this is not a loan we want to make, and I don't recommend that you pursue it because of whatever the reasons are. And unfortunately, though, there are a lot of salespeople, charlatans, whatever out there who are convincing and will make you feel like, whether it's a course that they're teaching, you know, or an investment opportunity, right? When they tell you 25% returns, my suggestion is walk the other way, right? That's not really realistic. When maybe 25% returns if it's your investment, right? But when it's someone else doing the investing for you, how are they going to get paid if they're giving you 25%?
Yeah.
So anyway, so I will say, I have I'm with Delarosa Lending. That's my firm, mine and my partner Jacqueline, and we are hard money lenders. And so you can look at us. We're at Delarosa Lending. Also on Instagram, I'm at Evan Shweky, EvanShweky. The reason I say that is every day or two, I'll post a 55-second piece that has to do with a latest scam, something real estate related, or something involving personal development. And you'll see I've done about 100 of these already, and I've touched on like everything, including these scams and what to look out for, because that's the most important thing. What I've learned is you can miss the good deals, because good deals come all the time. You just don't want to get in one bad deal, because that can wipe you out. So the key is to stay away from a bad deal. If you missed a good deal, you shake it off and you move on. But that's why it's so important to scrutinize any opportunity, whether you're an investor, an outside investor, or it's your own property that you're looking at. Go behind, don't listen to what everybody is telling you. You have to go beyond that in doing your own due diligence.
So how would you describe the current real estate market today if you strip away the media headlines?
So this is what I say, as far as lenders and as far as borrowers. I feel, and a lot of people disagree with me, that we are like, the economy has, yes, it has an impact. It has an impact in who we're lending to, right? There's always going to be, I'm going to talk from a lender's perspective because that's what I do. There's always going to be a demand for money in bad times and good times. Now we're in booming times, right? I heard one of our audience members talking earlier about like the prices for the flips, right? And when you look at the prices 5 years ago, they're up 60%, whatever it is. But if you're staying on the sidelines and doing nothing, you look at the deal today. You look at what the property is cash flowing today, not tomorrow's appreciation, but today, and you make that analysis. But if you are frozen and you do nothing, you're going to find another excuse 6 months from now. So what I say as a lender, we're like economy proof, because in good times, people are buying properties to build their portfolio, right? They want more rentals. We have a major housing shortage that is not going to be fixed for years. And so there's a demand for money for rentals. The economy goes to does very poorly. We're going to have foreclosures. We're going to have investors who want to buy these foreclosures and finance them and fix them and whatever. So for us, at least in my opinion, in my market, I feel like there's always opportunity for us to lend, which means if there's an opportunity for us to lend, there are opportunities for investors to invest. So the market right now is very strong, okay? But I'm going to give you an example of where you need to be careful. And this is one of my 55-second pieces. Austin, Texas, 4 years ago, used to be one of the most expensive places to live, okay? This year, it was one of the most affordable places to live, to actually rent. Why? Austin, the city of Austin, did something that most cities have not done, right? Part of the reason that we have a housing shortage now is because of zoning regulations, right? And limitations, inland wetlands, permitting, whatever. And they say that, builders say 30% of their costs are just dealing with the bureaucracy. Austin, about 4 or 5 years ago, loosened up all their regulations, and in a matter of 2 years, they added 50,000 apartment units, and the rents just plummeted. Who is that bad for? Well, the lenders and the investors, right? The investors. So when you're, again, buying the property, you're looking at the cash flow now, but you also want, again, doing your due diligence. Are they talking about loosening up? What's the I don't know enough about Philly, but I know there was at one point they had so many apartment units that were flooding the market that some of the builders were holding off. Now that may have changed now as they become, part of the, as they go online. But now I'm reading that actually, and you would know more again, that the city of Philadelphia is now buying units.
Yeah,
right? I don't know how that.
Yeah, I'm a little concerned about that. So when the Philadelphia Housing Authority is buying their own buildings, they're seeing an opportunity of clearing out the voucher, gluttony of vouchers that are out there. What does that do to the small landlord and days on the market on their own small single-family row homes? You're going to see a lot of emptiness. And the question is, who's monitoring the housing authorities when they're filling up these vouchers to their own buildings? I'd be very concerned from that, because that's where fraud, exists, and that's where you'll see another fraud case 2 years from now, because they start gobbling up all the vouchers that are supposedly out there for people in need of housing. I see a compression of debt service in the city of Philadelphia. I see a days on the market of rentals up. I could tell you in the more Class B markets, like where we had my holiday party.
Yeah.
I can tell you, I talked to a couple of the post office guys because those guys know. Most of those buildings are only at 50% occupancy. Okay, so that's not really good if you think about it. And they're still building more in areas where why would somebody go down there to a grocer when they don't even live in the area? It doesn't make a lot of sense. So there's a lot of things being built out in certain areas that they're now giving 3-4 months away in rent. So what do you see as the biggest disconnect between perception and reality in today's market for the small investor?
The biggest disconnect? Again, reading the headlines is one thing. And again, because real estate is so geographic, you're focused on a specific geographic area. Wherever you are, you have to go beyond the headlines and do actually what kind of Joe said is actually important, right? Going to the postman or the local grocer who knows what's going on in the neighborhood and seeing what's going on. And let's say there is like a 50% vacancy, okay? The other thing is you can make your property unique, right? So if there's a 50% vacancy, that means there's 50% occupied, right? 50% is occupied. And if you can stand out, even doing some minor things, whatever it may be, minor upgrades or whatever, you should be able to, that should not have an impact on your investment, in my opinion, okay? And I feel like, again, I look at other lenders and I look at investors and I'm like, if you just do a little bit more, and it's not much, you will be so far ahead of anybody else. Because we have a tendency, I think, as humans, right? It's fight or flight. We complain a lot. Like, we complain. But the complaining doesn't really help us. It doesn't, right? So we know, right, we cannot impact. Our circumstances are our circumstances, right? You have a 50% vacancy. Okay, what are you going to do? Not going and saying, I have 50% vacancy, whatever. No, I have 50% occupancy, right? You want to have an abundance mindset, and that will change your whole trajectory. So I'm really, by the way, because again, if you watch some of my stuff, you'll see it goes hand in hand. Because when I was doing, by the way, when I was doing these 1-minute things, I was thinking about other hard money lenders, and I'd look, and they'd go, and what do they typically do? They show you the rehab project of one of their investors, and it's great. But my thought is, no, like, that's great, but it's your mindset that's going to make you successful, right? Yes, you have to learn the ABCs of investing. It's important, but then you have to go beyond that, because you are going to reach roadblocks, whatever they may be. Issues with the permitting, with the inspectors from Philly take forever, and learn to deal with that, and learn how to negotiate with them, how to get them out there to come faster, and that can change, again, the trajectory of your investment, and that's the non-financial part.
So that ties into your thought of, are we in a slowdown, a correction, or a normalization phase, and why does that distinction really matter, or does it matter for you?
So if you look at the statistics, right, I think it was last quarter, 30% of all transactions involved investors, and like 85% of that 30% was of investors who owned less than 10 units. So the smaller investor is active right now. The other part of that is the margins are much thinner than they were 5 or 6 years ago. So you have to be really smart about how you're investing. And that's why I actually feel like the fix and flip market, you have to think longer term. And this is one of the things. I also own a multi-unit portfolio. And one of the things I said to myself when I was buying the multi-unit portfolio was, if I liked the property, I was willing to overpay. Because I didn't care, right? I was depreciating that asset over 27 and a half years. And let's say the property was $1 million, I was willing to pay 1.15 for it. Because at the end of the day, that $150,000, especially knowing that there's a major housing shortage, and especially where the area that I was looking at, I didn't mind paying, because I knew in 5 years I'd look back and I'd say, this is one case where I'm not, worst case scenario, the cash flow still made sense. It was a lower cash flow, but I felt that there would be appreciation, even though I told you earlier that's not, but forgetting, the appreciation would have been a bonus, right? And it's worked out well for me. I feel that in certain cases, and that's where I'm talking about the thin margins here, if you're keeping it for the long term, you'll look back 5 years from now and be like, you know what? Look, in 5 years you already paid down some of your principal, right? And now it's your money. And if you did nothing, you're getting 2% in a savings bank or something. And so that's why I say sometimes you just need to. The market is active.
Yeah.
It's still active, even though the margins are thinner. But small-time investors are very active right now.
Yeah, some prediction factors I'm seeing just from a data review. I mean, I review data all day. I think we're going to see something happen somewhere between January 25th and February 15th. And I don't know if it's going to be a market, reset in the stock market.
How do you come up with those dates?
Well, because you got some big markers coming around here. You got a lot of people going into the new year where this past administration talked about a lot of money coming back into the United States. We need now to see how that's translating into jobs, and we had the government shut down where a lot of the reports were kind of skewed. You didn't have real clear numbers. You have a Fed chair changing and announcing somewhere between January 25th and the 15th of February. So we're going to know who that new Fed chair is. And how is the market going to react to that? You have fraud cases popping up. So what role should private lending, debt service, or non-QM capital play as we move into 26? Like, what are you looking at differently from a private? It's your money. You're putting your money where right down on the dotted line. What concerns do you have knowing that we have a Fed change coming up as of March 1? Powell's out. How do you think that's going to react to your money cost and your concerns?
It's a great question, and the answer is not an answer that you're going to really think is a great answer, but it's all. It's like I ignore
we're on a stage. I know that,
right.
But I mean,
it's like. First of all, right, we care about where interest rates headed. I think they're pretty much flattening out. I don't think they're going down. I don't think they're going up. I think we're at, we see the unemployment rate slightly increasing a little bit. I mean, my concern actually is a little bit on this AI thing, where I do feel like jobs are going to be eliminated, at least early on. I mean, I know how I use it, and I'm like, oh my God, I don't need a personal assistant for a lot of things. No. Or, this thing, I'm in the car in 2 seconds, I get whatever answer I want.
Yeah, it's like a cookie monster, you just keep feeding it cookies.
Right, and so it's got to have, and it's got to have some impact. So here's one of the things now, right? This isn't construction. This is an interesting statistic. The data centers that they're building for AI now, if you took away the money that they're building, the investments in these data centers, we would be in a recession right now. That's how much they're investing. Like, that's how much of an impact. So what happens if you've seen in the last few days, all of a sudden the NASDAQ started to that's more of a concern to me than the Fed chair, right? Is that we're so invested in AI, but it's not just the AI. There's the data centers. Those are construction jobs. There's lenders. Yeah. That's something that is, but for me as a private lender, for my niche, people always, so I said to myself, when I was a lawyer and then I was a trader on Wall Street for 9 years, and when I decided to go focus full-time on real estate, there's a reason, because I said, there's two things that won't change. We can have the AI, you can have this and that, but people will always need a roof over their head and they'll need to borrow money. And those are the businesses that I'm in. So I don't really, yes, I'll use the data that I see, the macro data, but for my market, I know people need a place to live. And as long as I have, the funds to make the loans, I'm not worried. Because even if we have a crash, people still need a place to live. Yeah. It just means that as an investor, you can buy it cheaper. Right? It's like dollar cost averaging. When you go into the stock market, every month you put in, let's say, $100. Market's high, market's low, and it's the same with building a portfolio. You're never going to buy at the bottom. Hopefully you won't buy at the top. But over time, you're averaging in, and you're going to build a portfolio.
Yep.
And you have to start. And times are robust right now. So you're not making the returns that you would have made 5 years ago. But that's 5 years ago. That's gone, right? You want to make the best returns you can in the market that you're in today.
So it's funny that you brought up the AI piece, because all my RTL, meaning fixed to rent, fixed to flip, and new construction, they are eliminating the appraiser. Everything's done by AI. So the entire appraisal is back, identifying either off or on market real estate sold and settled within 48 to 72 hours. You will be able to close a fixed to rent, fixed to flip loan in 10 days without the appraiser. Now you could ask for a physical appraisal,
right,
but why would you do that if the AI is picking up everything that maybe an appraiser will not pick up, right?
Well, the AI can't go in the building right now.
No, but they're doing pictures with it.
Oh, you're submitting.
They're supplying all.
I understand.
It's done in 48 to 72 hours.
Right.
So knowing this is down, it's here. It's not down the road. I predict also DSCR is going to be virtual appraisals probably by the end of the year. That's if you're doing virtual appraisals already on fixed to rent, fixed to flip, and new construction. The secondary market that's buying this paper is almost just about there to accept the DSCR AI. I mean, but it's
right.
We see robots doing electrical work and sheet rocking and everything. How far away is that from eliminating a human being from doing it? Right? It's here. It's not 5 years from now. It's now. It's probably in the next 12 to 24 months. What job is that going to eliminate? So, tying that all into our discussion, where do you see the strongest opportunities emerging over the next 12 to 24 months in our 100-mile radius of where we're sitting right now?
So, Pittsburgh right now.
Yeah.
I mean, people know about it, but it's still a valuable area right now. They said actually owning is cheaper than renting there right now.
Yeah, I would agree with you on that. That's been that for 25 years, 30 years.
Well, I guess then it'll be another year,
yeah.
Right? And so Pittsburgh and Scranton and Syracuse, New York is also a very popular place right now.
What do you think about Cumberland, Salem, Gloucester County, Jersey?
So it's very funny that you say that. I have a borrower who's they're very wealthy. We've got about 7 loans with them, and they're using other lenders as well. They are buying like crazy in those areas, and let's say they're spending $115 to buy it, and they're putting in another $30. The after repair value is probably close to $200. They're doing all Section 8 housing, and they're doing it very well. If you don't have the right, then maybe those are areas you want to look at, because you can pick things up a little bit cheaper and there's opportunity there. Now, Section 8 housing is, I don't deal with that. Like with my multifamily units, I don't deal with Section 8. It's just not my thing. But if you know how to handle it, it can be a very lucrative area to be in. So I think those areas, there are opportunities. In fact, I was driving, I don't know where I was driving in some of those counties, and you see there's a lot of dilapidated properties there. And so, I mean, that it doesn't really matter, right? You could find a dilapidated property that's worth $1 million in a $5 million neighborhood, or one that's worth like $60,000 in a $125,000 neighborhood. So a lot of that depends on, first of all, your temperament in dealing with those kind of tenants if you're not flipping it, and also obviously your liquidity.
So what risk do you think investors are underestimating right now?
What risk are investors?
Repairs, values, liquidity. What are you seeing the most?
I'll tell you, this is, and I've said this forever. Some people won't like hearing this, but it's just, your general contractor will make or break you. And I'm finding that because of the crash of 2008, you had a lot of people leave the industry. And I've talked about this right now. The trades are, if you're young, I have a guy, he's like a Rastafarian guy. He's an electrician. He has 8 trucks. Guy's making a killing. in my multifamily portfolio, my HVAC guy comes, whenever he comes, it's like $4,000 or $5,000. And part of the problem is the reason those plumbers you're paying so much money is there's not a lot of them out there, and the ones that are out there, not all of them are actually that good. So I feel like the biggest risk for any investor, honestly, is who is doing the work for you, and that's one of the things that I want to find out when I make the loan. How do you know this general contractor? When they tell you he's a friend of mine, that's already a red flag. And so that to me is the biggest risk, because the numbers are the numbers, right? What are you paying for the property? What's going to be the rehab cost? And what's the after repair value, right? And then figure out what you're going to take the loan for 6 or 8 months, and what's that going to cost you, and you put it in there. But when you get the GC and all of a sudden he's like, oh, we found this, and you don't know if he's honest or not, that's where there's a problem, and that's where it can be a very big problem. And I have one loan that didn't go so good because the woman, it was a home run. She bought it in Philly. She paid, she put up $85,000. I think our loan was about $390,000, and it was going whatever. Her boyfriend, it turns out, was the GC. But it wasn't really her boyfriend. I mean, it was her boyfriend, but he wasn't very nice about it, and she gave him the money, and that was the end of that.
So what advice would you give newer investors, or even just experienced investors trying to enter the market in a new market under the uncertainty that we're seeing right now?
So there's always uncertainty. I mean, that's the end of the day. Nothing is 100%. You have to just limit the uncertainties and get to a point where you're 65% certain. And if it's telling you to do it, then do it, okay? And know what the downside is. So, right, as a trader, one of the things I learned about is risk reward. That's what you have to do. So if I go to my attorney and talk about something, they'll tell me never to make a loan in my life, right? Because they want the risk. If it's 10%, but the reward will always be 0. Although I told you want to avoid making losses. But you have to analyze, there's always going to be a risk. I don't know, you could be in some environmental thing that whatever, but if the numbers make sense to you. And I saw something interesting today. Somebody was saying, he was saying that off-market deals, they're off-market, but that doesn't mean you're getting a deal. There are plenty of deals on the MLS that you can make money on. Yeah. You just have to find out.
I 100% agree.
Yeah,
so when I've seen wholesalers dousing people with $50,000 to $90,000 wholesale fee, that's a joke.
Right. Well, that's a whole nother thing.
I mean, So for the experienced investors with portfolios, right, small, medium, what should they be doing now to prepare for 26?
Buying more, and not listen. I'm a big believer in buy and hold, like Warren Buffett. Buy and hold. I know that my portfolio, started in 2012, and listen, I also got lucky, right? It was a perfect time it was a perfect storm, so to speak, and it's appreciated so much. And I stopped buying in 2017 because I thought the market had peaked. I was totally wrong, but I kept the portfolio. So I'm still getting the benefit of it, and I've taken a different tact. I pivoted, and I'm lending, and that's what I actually like doing now. That's what I like. That's where I feel comfortable. But so my feeling is, if you're an investor, you buy in good times and you buy in bad times. Again, it's like dollar cost averaging, because you don't want to be sitting around for 5 years doing nothing. That's just my opinion, and other people may say, no,
I agree with
cash and wait till the crash happens. But what if it doesn't happen?
Well, that's what I'm saying. I feel like liquidity is key, and you keep leveraging onto the next big. Like the most popular restaurants out there have a couple bad restaurants, and the really good restaurants are covering that.
Right, so diversified.
Exactly, they're staying very balanced out.
Right. So to your point. along with the acquiring, don't over leverage.
Yeah.
Leave yourself room for the crash.
I tell people, I tell most of my investors stay at 70%.
Yeah.
At 75, 80%, you're
Right.
really at a risk. But I got
Yeah.
money stuck in the deal. I said, make
Yeah.
it back on the cash on cash. I'm telling you, do a depreciation instead of 27 years. Do a 10-year. Do a cost seg if you can get away with it, because if that's how you're going to capture some of that money back.
So the other thing I would say is, if you've got a dud or something, you've got your sunk costs. Forget about it. If it's a dud, for whatever reason you're having issues, criminals in the area, whatever, dump it, take the loss, and move on, because you're going to think about it all the time. Instead of focusing on abundance and growing, you're going to be thinking about, this property, it's like whatever, dump it. And in 6 months, you won't even think about it anymore.
So I got one more question, then we'll talk a little bit about health as well. So if you had to make one bold prediction for the real estate market in 26, what would it be?
One bold prediction for the real estate market in 2026, what would it be? Prices will be stabilizing. I don't think, I think that the way they appreciated since COVID was incredible.
Yeah.
But I think now you're going to have more like a 2 to 4% annual appreciation.
I would agree with that.
I think, listen, this whole tariff thing was no one knew what was going to happen, but it seems not to have. Yes, some prices have gone up, but it hasn't destroyed the economy the way people thought. I actually think 2026 is going to be a boring year, stable and steady. I don't see any major downside. I don't see any major upside. Yeah. And so slow and steady wins the race all the time.
The tortoise and the rabbit. I've never seen a story where the rabbit ever won.
And again, Warren Buffett, you buy and hold. You buy it and go to sleep and let it do its thing, and let time lift things for you. And if it takes a longer period of time, that's fine. Look, are we due for a recession? Yeah. But the way, the way it is right now, I just don't see it in the next 12 months. So what do you do? Again, are you going to sit and wait? Because it could be in 36 months. Yeah. And that's where I just say, don't over leverage.
Yeah, I would agree with you. So health and wellness, which I'm a big fan of. I've spent over $100,000 in my recovery of a massive stroke. So, hopefully nobody has to be part of that. You've seen it. You saw it hands-on. So what are you doing differently health-wise over the last couple of years differently now?
Yeah.
Now that you hit 39 and you're moving on
61,
to the big 40.
So
what are you doing differently to kind of stay focused on top of it?
So I'm a big believer, by the way, in your investing's great, but your health is more important. You want to be a great investor? Stay in great shape. You think sharper or whatever. And one of the things that I've always done is resistance weightlifting or whatever, and it's really important as you get older, and this is not really a health class, but I will tell you what I've done in the last few months is focused also on the cardiovascular part of health. And I'm sure you guys heard of Peter Attila. He's been on 60 Minutes and whatever, and he's really amazing. And I'm just going to put out this one thing that I've started to do. So they did a study, a 5-year study or 4-year study of 2,000 people who were 50 years old, sedentary and healthy. And they put them on this program where you either run or you bike or you swim, and they found that if you do 150 minutes a week of what's called VO2 max, so where you're uncomfortable speaking to somebody, so that's kind of a very brisk walk. If you do that for 150 minutes a week, and then 1 day a week, for a half hour, you do what's called a Norwegian 4x4, and this is the most important part, because the brisk walk is just maintenance. The change comes when you do this 4x4 thing, where let's say you're on a bike, you pedal as quickly as you can for 4 minutes, then you take a 4-minute, you go very slow for 4, and you do that 4 times. They did this study over 2 years, and they found, this is like incredible, they found that the age of the heart of those people, 50, was like that of a 20-year-old. 20 years they took off, and they said that this Norwegian 4x4 was key. And I just feel that the most successful people are the people that right? They're disciplined. So it's about eating well, sleeping well, exercising. And if you're doing all of those things, chances are you're going to make better decisions in your life. You're not going to be lazy, and you're going to look for opportunity. I find that if I don't work out in the morning, I'm not depressed, but I'm like sluggish. I definitely am not as efficient at my desk. And so so what I'm doing differently is I'm doing the resistance training, but I'm also doing this cardiovascular thing, and I feel great, as good as and I always say I want to be the best 61-year in that category, right? I'm not 25, but I want to be the best 61-year-old out there. So if there was an NFL for 60-year-olds and above, I'd be drafted. Maybe not in the first round, but.
And my last question. So, What was your claim to fame to Hollywood?
Right. My claim to fame. So when I was a trader with the Royal Bank of Canada Capital Markets, this is years ago. Did you guys ever see Wall Street? Okay, that was a classic film, right? So, oh God, who's the director?
Oliver Stone.
Oliver Stone, right. So Oliver Stone decided to do Wall Street 2, The City Never Sleeps. And they came into our office at RBC. They rented it for a day, and they asked us as traders to stay for, they were doing a scene in our office. And sure enough, there's a line in there, and I actually asked Mr. Stone if I could do the line. He said, yeah, go ahead. And I did the line. He's like, do you have your SAG card, your Actors Equity card? I said, no. He goes, good, you did a great job, but I can't give you the job. By the way, it was one line, and they said the guy who got it with residuals would make about $50,000. And anyway, so I was in the background, you see me, and I was about 40 pounds heavier or 30 pounds heavier. Like, like you make hands like you're buying and selling, whatever. And now it's totally different, right, with the computers, the way it was. So I was in one quick scene. I went to the movie to see it, and I missed my scene because I fell asleep. It was so boring. The movie sucked. It was with Shia LaBeouf, wasn't it? It sucked. But anyway, and I was a theater major in college, but I never pursued it. But anyway.
Well, that's the claim to fame. So we're going to go around now to ladies first. You had plenty of content to kind of absorb. We'll go with Christina first. Do you have a question for Evan? Or
Evan, thank you so much for your presentation. I appreciate it.
Pleasure.
Can you give an example of a specific project that you did a fix and flip? And you mentioned for us to be careful with contractors. Have you ever had a bad contractor, and how did you handle that situation?
Yes. So I've had a bad contractor when I was actually doing because before I got into the lending business, I was doing some fix and flips. It just wasn't my thing, and I'd make money, but I learned that if you don't know, like, the price of a 2x4, let's say, okay? If you don't know any of that, they can like pull the wool over your eyes very, very easily. So here's what I do to really, instead of giving an example, let me tell you how to prevent it, okay? So generally speaking, when you go to the general contractor and you have a project, and let's say it's $60,000, they may even say to you, we need half up front. Let's say they say we need $30,000 up front. And 9 times out of 10, they're using that $30,000 for the next project that they're working on. So what you need to say to them is, listen, Mr. or Miss GC, I'm going to give you a good faith deposit of like $4,000 to get started. And we're going to have a scope of work. And you're going to get paid based on that scope of work, right? So when you do the demo work and the kitchen, I'm going to give you $15,000. And he's going to say to you, or she's going to say to you, well, no, I'm not doing it that way, because if I do the work and then you don't pay me, I'm screwed. And your response to them, and this is the response, this is why you don't give them money in advance, is, Mr. or Miss GC, you have more leverage than I do. If I give you the 15 grand right now, you can walk away. There's nothing I can do. Go sue, you'll never get the money, I can promise you. They'll create another LLC or whatever. But if he does the work, or she, and you don't pay them, they can file a mechanics lien. There's nothing, they will get their money. And you need to make that clear to them. And if they keep pushing you, it tells me that they don't have money, and that means they're not going to do, a real GC should be able to work for 60 days without getting one paycheck. They should have cash of it. You know what I mean? If they're reputable, if they're going from job to job, it's like you don't want that person working. So if they're pressing you on that, I would say, you know what, I don't think this is the right relationship for us. So that tells me, right, because a real GC, if he says that's fine, he's got the capital, because he's paying the 15 grand to get the work done before you're reimbursing him.
You don't have to learn once. You don't have to learn once, and then you'll never do it again. I agree with you that we've been both been had on that. So thank you, Christina. Kathleen, do you have a question?
Thank you for being here. It's been very interesting. And my question would be, to start out, the way things are, if you have no cash at all, but you have good credit, you have the building experience, what would be your suggestion on how to get started?
Okay, I'm going to tell you right now, and I always tell people, if you have cash, you're not getting, no one's help. You need to partner with somebody who's doing it and say, look, I'm going to work for free. I want a piece of the equity in the deal, and you need to build a little bit of a cash base. I always tell people, you should have at least $30,000 to get going. If you have no money, people tell you about going and
no money down,
and all that nonsense. And they have these courses, how seller financing, they're not financing 100% of the, and no lender's giving you money if you have nothing in the bank. So the realistic thing is to find someone who is doing deals and add value, right? It's always about adding, like
what do you bring to the table?
Right. It's always like when you want a mentor, right? They say when you're looking for a mentor, you don't go to the mentor and say, oh, you're so great, if you could coach me. No, you say, I would like you to be my mentor, but here's what I'm giving you. So you have to, it's a transaction. You're bringing something of value, and they'll give you something in return. They'll give you more knowledge, and you need to get a piece of the action. That's because you're trying to build capital. And that's a great question. No money, it's not happening without help.
I agree with you. I'm a big fan of that. So we'll go with the gentleman. Michael, we'll go with you first. Question for Evan this morning?
My wife and I were very young, actually, close to 50.
Oh my God.
Advice for you have.
What do you do for health? Because I guess I have to do it.
So I didn't mention I have a lot of strange side hustles. I work in IT for the city, but I actually have a fitness coaching side hustle and a self-development company, and I'm doing some digital e-commerce things. I have a lot of things kind of like I'm working on the side.
Right.
And real estate investing is one of the side hustles. She's doing it full time. I guess my question would be for someone who's a later investor in life. We don't have a ton of cash, but we have some money, obviously. We've saved up some, invested some, but we have some room to invest. Like, what advice would you give to someone that's moving a little later in life? Because I don't have the luxury of waiting, of making the mistakes a 20 or 30-year-old would make, and also have the experience that a 20 or 30-year-old would not make. So I kind of want to invest a little smartly because I don't know how.
Right, and that's the thing. So here, and I'm not. This is not really a plug, but I'm going to just say. So sometimes it may make sense. So you have to decide, do you want to be a landlord, or are you doing like a fix and flip? Or do you want to be involved in real estate but as a passive investor? So, and again, I'm just saying one of the things that we do, we use our own money, but we have outside investors. So we tell them, we give them anywhere between 11 and 13% on an annualized basis, and they're participating. We put money up, the investor puts money up. Our money is what's called first loss capital if there's ever a problem, and there really never is. We always get our money back in the end because I'm very conservative. But we have a first mortgage, we have a title policy, we have not an AI appraisal, we have an appraisal by a certified appraiser, and that's a way to get involved in real estate. Like when you're later in life, if you don't want to, because there are a lot of headaches, right? Now your wife though is a realtor, so she kind of knows things, so that's one avenue. But if you're really looking for the actual physical asset, I mean, you kind of said it. You have life experience that the younger person doesn't, and you're going to be more cautious. So again, as I said, miss the bad deal. Keep let the good. If you're missing good deals go, that's fine. And you need to really sit down and say, what kind of returns do we need? How much money do we have? What can we buy? And actually, this is one of my segments. I talk about, I forgot what the name it's called. There's a way to do it where you really isolate how you're going to invest. So you find the geographic area you want to be in. You see the cash that you have. You see what the buying power is that you have. You see what the returns are that you have, and then you do a search on the MLS, and it's going to narrow it down and whatever. And so, again, you can't be 100%. There's always some risk, but if you're doing the homework, you're narrowing that risk if you're doing the due diligence. But again, at the end, I say it's the GC is the most important. They say where you buy it, which is true. But then that GC is so key because it's so easy for them to have overrides and overcharges and this and that, and then there's delays. You can't get them for 2 weeks or 3 weeks. So that's something that you have to figure out on a. Yeah.
And we talk about that all the time at these different events. I think you get my vibe is a lot different than what I've been part of in the last 6 months. I've been fighting. There's a lot of unrealistic people out there that are not in reality of what the real estate industry is, and they're going to be on a hamster wheel pretty much for the rest of their lives if they don't wake up and smack themselves in the face in the mirror. You know what I mean? So that's what my additional add to it. I'm a little more blunt than Evan. I peel the onion real quick. So Andrew, do you have a question for Evan?
I do actually. So you mentioned that if you've got a dud, you want to get out, essentially. How do you know when a deal's a dud? Is there
When you're looking, well, so you will know. Believe me, you'll know because either your bank account, it's draining your bank account every month. You're paying more than it's coming in for whatever reason, or you have headaches, like it's in a bad neighborhood, let's say. Okay, and you didn't expect it. You thought you're in Kensington or whatever. Yeah. You bought it cheap, right? And it may actually be cash flowing positive, but the headaches are, again, you have to have an abundance mindset, and if it's a distraction, you can't focus on the future. You're focused on that. So it's like kind of an intuitive, it's either going to be a financial feeling like the numbers are saying you're losing, so you want to stop the bleeding, or it's just a distraction, and that's, you'll know. I mean, you'll know when it's a dud. You'll also know when it's a winner.
Yeah, that's true. I would agree with that. Adam, your question for Evan this morning.
This is going to be my dud question. I guess how do you evaluate if it's a dud, or I have a property, I haven't been able to rent it since August.
You haven't been able to rent it?
Yeah.
Okay, so you need to see, is the rental price that you're putting up there too high? I mean, that you're not getting any calls?
People show up for the showings, and then they just...
Are you doing the showings?
I am doing the showings.
Okay, so you're doing the showings. You should stop. I got to be honest with you. I would almost follow up with the people afterwards and say, what is it that held you back? And if they say, well, the bathroom, something that you know what I mean, that you get some input from them. That's what I like realtors. Usually realtors, when they do a showing, the listing realtor will ask the other realtor, well, what was it that they didn't like about it? You know what I mean? And now, the other thing that you can do, and this is a trick that someone once told me, was like when they do a showing, they come out and let's say there's some imperfections, but for whatever reason, there's a beautiful view outside the kitchen, right? And you can see deer or something. But there's other things that aren't so nice about the house. When you go out, and you're leaving you go out with the potential purchaser or purchaser or renter, you say, oh my God, can you believe that view in the kitchen? Imagine waking up every morning, having a cup of coffee and seeing the deer out there, and that's going to be the last thing they remember about the house. They won't worry about the ugly green in the bathroom as much. Now, look, that doesn't mean you're going to sell it, but it leaves them with a positive impression. So if you can think of one or two things that are really good about that apartment as they're walking out and say, look, I know you want to think about it, but you're getting this and this that other apartments in the neighborhood don't have. Again, there's no guarantee, but I think the first thing you got to look at is the price. Okay, I don't know what are you asking for a month?
I was asking 1,800.
18. So it's like a normal kind of range, you know. If I had to ask you, what do you think's wrong with it? Is there something? I mean, is there something wrong? You're talking 4 months. You haven't been able to rent it. Objectively, what would you say is the worst thing about the apartment?
Honestly, I was debating this. I left a cable cord that came in the window. Somebody had like pulled it through the window, and I left it there in case people wanted cable. And I was kind of like, maybe I should be pulling that out.
I don't think that's it.
See, this is what I would ask. Okay, price. Are you giving enough discount away on the 1 month? We talked about this. So he's at a half month rent. I would give a full month rent. I'd lower the rent maybe by $100. I'd also evaluate what's wrong with the bathroom, what's wrong with the kitchen, and what's wrong with the closets, because this is a Section 8 housing play. It's a PHA deal. So if there's not enough closets, and the kitchen, something's wrong with the kitchen, or something's wrong with the bathroom, or something's wrong with the basement. You know, where's the washer and dryer situated? Like, there's got to be something. If I walk in there, I'm going to tell you, I'm going to be able to point it out in about 2 minutes, because I will notice something, because you're missing something. Because it's numerically impossible that you have an empty unit for that long unless there's a problem. And you're going to be next 1 second. But do you understand what I'm saying? There's something. If you want to come up and just do an audit walk with you, I'll do that.
Or take pictures and send
or send me pictures, because I'll be able to see it. That's just a thought. And I just want to leave it there. I don't want to get you all more stressed out than you need to be based on hearing this. But I think these are things that you need to hear, to think about when you walk away. What are you going to do? Because you got another unit like this too, right? Okay, so there's something wrong with that one too. Then you got to look at it, because everybody looks at a kitchen, bathroom, closet space, and basement. Okay, everything else is irrelevant, and the rent.
By the way, so I was just going to say, so Joe actually just gave you some really good advice, and I'm sure you're stressed about it. But here's the beauty of it: now you've just been educated. You're going to do that. You're going to fix it. And you're not going to have that problem again. Like, it's not going to be sitting there for 4 months next time, because you're going to know about what I need to think about, right? You're going to think about it in month 1. Why is this not renting? You know, and you have to look at, is the market hot? Is it really, are there a lot of vacancies or whatever? But in this market, and at that price, for 4 months, there's something, and it's fixable, right? Whether it's a lower price, and I don't know if you have a mortgage, if it's going to be like, oh, so now you're subsidizing it, whatever. And again, in that case, it just may be a temporary subsidy, because you're also paying down principal, you know, and you're building equity. But I think that advice will help you down the road.
We just want to get through the questions. So what's your question for Evan? Well, we'll come back to it. Okay, go ahead.
No big deal.
Go ahead.
It's simple. Check the competition out.
Well, it's the same thing. It's the same, because
then it'll give you like let's say, oh, that because a lot of times I see a lot of people can talk in general, but go to the actual apartment to see what's going on in your competition.
Yeah, but I mean, if it's a PHA Section 8, your
This is what it is.
the voucher kind of speaks for itself.
I don't think there's vouchers out there actually regular tenants. I mean, I'll take anybody.
You're looking at market rent again? See, this is the problem now. Now it's an area where there's a lot of Section 8, and your market rent might not be as appealing in that same area.
What's the area? Like, let's say I buy in Baltimore, Newark, and all that stuff. Is I'm renting a place, and let's say I want to see what the other places are doing.
Yeah,
right. You're saying physically go to.
Well, see the other for rents. I mean, you are a licensed agent. You can't go. You can tour for yourself. But this is the concern I have with this now. Like Newark, because I've owned in Newark, I've lent in Baltimore. It's block to block. Okay, and your market rent is not as appealing as Section 8 in those markets. That's a fact of life, and whether you want to hear that or not, and who you're going to attract on a market rent in those markets. Listen, I have clients that own 500 doors, 600 doors in West Philadelphia. Okay, 7,000 doors maybe at this point. Guess what? They'll stay empty for 6 months till they get the right tenant. They'd rather pay the heating bill for 6 months.
It's just the basic stuff. It's like,
but do you understand what I'm saying? They'd rather go empty than get the wrong tenant.
If they're renting out,
I understand.
To get somebody out of one of these places listen. Getting somebody in is easy. Getting somebody out is the real hard part.
It's still 4 months.
There's got to be something. We don't know what it is.
So I like to see what's he doing?
So I bet
sometimes it's just like the market.
Yeah.
You might have like that the market is a certain way.
Yes.
You just didn't.
No, I
Yeah.
understand what you're saying. It's not, yeah.
I'm going to bet if I go to these 2 units,
Go out and get a
Sure.
to meet some people. You know,
Right.
so I bet if we go to these 2 units, we'll find what's concerning. So, what's your question for Evan?
So the question, and I find very entertaining. Like a lot of stuff that you're saying. But 2006, like, and to 2026, right? What do you see any parallels, like, in terms of, like, because a lot of the places I see that the rents are like extraordinary, they're high, but
Yeah.
the pricing, when you look through the math,
They don't match up.
In some markets, you're people buying negative cash flow properties, and, like, let's say you start getting into Brooklyn and all these other markets.
Oh, they don't even.
It feels a lot like 2006 in like the forensically, meaning maybe not Philadelphia, but you start.
So remember, the 2006 though, people were buying with no money. So there may be negative equity, but remember, equity's built up so much in the last 5 years. So even if it went down 20%, but it's been up 50%, you know what I mean? You still have a net, there's enough equity. You know, that's why foreclosures are, you're not able to really buy on the cheap with foreclosures, because there's so much equity that the sellers can still sell it on the open market, even at a discount, but they have built up equity in there. And I again, listen, you know, I know that they talk about you're not supposed to spend more than 30% of your whatever gross income on rent, and some places are in New York certain up to 50%, right? Again, unless we have, and that's why, again, this AI thing, for whatever reason, I feel like, and Andrew Ross Sorokin had said, there's going to be a bubble in that, because there's so many, you know, you look at ChatGPT,
so much that people are gonna
they're
laugh.
putting in $1 trillion, they're not going to make money for like 5 years. Now, this other one, there's a Gronk or whatever, they are making
Grok,
money,
yeah.
but
That's right. I use ChatGPT
Right,
and
so
Grok.
so AI will be here to stay. It's just who are going to be the players. But my more concern is about the actually hard assets, these data centers. Are they being overbuilt? And is that going to impact the construction industry, where you're going to have, so then you're going to have fewer GCs because they're going out of business or whatever. Again, that's kind of like the macro thought. But for our type of lending, I just feel like it's okay.
2006.
Yeah, I mean,
No,
listen,
definitely not.
I think the difference between 2006 to 2008, from 2025 to 2026, I'm going to tell you really the real difference. You have more money than you can ever have than real estate. You had no money and a lot of real estate in 06 to 08.
Right.
Now, the second bullet point to that is you didn't have non-QM. Non-QM didn't establish itself since post 2008, when the hedge funds came together and said, "Hey, listen, we're not going to ever allow this to happen again. We're going to follow guidelines instead of regs." Blah blah blah. Now, the concern I have with the new Fed chair and the Trump administration is, do they deregulate the banks?
I thought they just started loosening up.
No, yeah, but do they deregulate the banks to compete with the non-QM? Because now non-QM, they say sometime between in the year of 26, we're probably going to be at 40% of the industry.
Oh, wow.
Okay, whatever Gen letter they are,
Right.
the younger crew,
Z or whatever,
Z,
yeah.
Y, whatever they
Yeah.
are, they're not buying houses.
Yeah.
They want to be put in a row home. They want to be put in a multifamily Class B market. They go to the gym, the co-working space, order their stuff from
Experiences,
from
do
the
experiences.
Amazon, have their dog shit up on a green roof, and go to their pool. That's it. That's what they want to do. They want a controlled environment. Now, there's going to be some people that want to have the single-family blue-collar man dream and think they have a make-believe garden in the back, but they don't want to own it. They want somebody else to do their work. They're lazy. So, to the advantage of the individual that, on average, here is 45 and above, we're going to be their landlords for the rest of our lives. Then how do we handle that? How do we facilitate?
I think the home buyer class is going down.
Oh yeah, I see more realtors trying to offer investment seminars that don't know how to be investor-friendly realtors, which I find entertaining, which is fine. If I was a real estate agent today, which I am, but if I was going to team up with a real estate, if I was a real estate agent trying to stay in front of people, I'd be offering everything in my mother in regards to DSCR, fixed to rent, fixed to flip, and new construction, and a line with a non-QM lender to have those discussions to attract people into your whatever you're holding, because that's your space. I don't know anybody really buying a house unless it's out of necessity or tax purposes. I see people flipping homes or holding homes. My flippers have become holders. All my flippers have become holders. All of them. They're not flipping anymore. It's done. Especially in the urban settings. I mean, Baltimore's done. I mean, that's just done for a while. It's been done. Philadelphia, you're pretty much just about there. Okay, there's no markers attracting people into this city anymore. There's no abatement. Now they're supposed to bring back a 20-year abatement. We'll see how that goes. All your developers left to the Jersey Shore, Reading area, Lancaster area, Delaware, better barrier of entry. So, Evan, I want to thank you for coming out today. This has just been great. You know, just catching up with you.
Yeah, it was fun. Always a pleasure.
Some final thoughts. You know, who's your client going into 26, and how do we reach out to you if we were going to be your client going into 26?
Right. So, my feeling at Delarosa is, yeah, I say we do fix and flips, but at the end of the day, if you have a hard asset, if you have real estate, we're interested in doing business with you, and we're very flexible in how we do our loans. And you know, credit scores are not as important as much as the asset that you're doing and the project that you are proposing. So if you want to reach me, you can reach me at E Shweky, SHWEKY, at Delarosa, D as in David, ELAROSALLC.com. Again, you can look at our, actually we have a web page, I think, DelarosaLLC.com, and we have an Instagram page at Delarosa Lending, and then also I have my own personal one at Evan Shweky, at EVAN Shweky, Instagram, where you could see like my daily snippets,
which we post into my mastermind strategy groups almost on a daily basis. We love doing that.
Yeah, or you can actually friend me on Facebook, and I'll friend you back. And so, and I actually do enjoy, I enjoy teaching. During COVID, I started doing videos about real estate. You can follow them. It's on a site called Swipe Left for Success. It's on YouTube. But now I just do these 55-second vignettes. They're low budget. No, I get to the point, and it's something relevant to real estate, or self-growth or whatever. And again, I feel like they go hand in hand. To be successful, you have to know how to deal with people, and it just, you could be the best finance guy, but if you don't have any communication skills, you may not get the loan, or you may not be able to sell the property. And
I agree with you.
So they go hand in hand. So I don't even talk about my business, because you're borrowing money, you're going to pay a certain amount, the rates make sense or they don't. But to me, it's more important to be able to say, hey, here's something I read in a book that I think's really interesting about how to handle this kind of a situation. And
well, thank you again for tuning in with Mr. Evan Shweky and our live audience today. This is Joe Scarice, nationwide direct private lender, podcaster, coach, white label specialist, investor owner. We're here every second Saturday of the month providing insight, education, strategy with a different real estate professional, and it was great to have Evan here. We're also here second Monday evening of the month, 6:30 to 8:30. We're in Lehigh Valley second Wednesday of the month at Fegley's Bethlehem Brewworks. Also we were in Harrisburg second Thursday of the month at the Red Lion Hotel, and then the third Thursday of the month we're at the City Rub Smokehouse down in Newark, New Jersey. I hope to see one of you or any of you here. You can just go to my website at josephvscarice.com and go to the events link, and all the events are there. It all links back. And then also, if you go to our podcast as well, creativeburststrategies.com with 4 R's, the event link is there as well. We do have some upcoming white label courses coming into the new year. I also want to thank Mr. Yardell Perkins of Perkatech, who provides all the social media backup and background to all this, teaming up with my Google team in getting this information and content out on the website and getting it in front of everyone. And I look forward to seeing you all again. And this Sunday we took off. We're not having our podcast tomorrow morning. Yardell and I gone fishing. We took the Sunday off, but we'll be back next Sunday at 9 a.m. Eastern Standard Time with another great subject of education, networking, and strategy. So thanks, guys, for tuning in, and we'll see you soon.
Thanks. Thank you.